Welcome back to Investing Talk Podcast.
Today we're looking at Reviva Pharmaceuticals.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Reviva.
Yeah, let's do it. So what's the big picture here?
Well, it's what you might call a classic late-stage biotech story. They are focused squarely on central nervous system disorders.
CNS, right. So things like major psychiatric illnesses.
Exactly, that's their main focus, though they do have some other programs in pulmonary issues.
And the whole investment thesis, the reason anyone is paying attention, it really seems to revolve around just one single molecule.
That's it. It's all about brilaroxazine. The lab code is RP5063.
Okay.
This is their lead asset, and look, they're positioning it as a potential best-in-class treatment for schizophrenia.
And best-in-class is a term that gets thrown around a lot. We need to unpack what that actually means here.
I agree. Because with CNS drugs, especially for schizophrenia, it's always this really difficult trade-off, isn't it?
For sure. You get a drug that works, but the side effects can be just awful. The weight gain, metabolic problems, motor issues.
That's the whole game. Patients stop taking the medicine. And that's the critical insight here with brilaroxazine. The data suggests it delivers strong efficacy without those really debilitating side effects.
So it works, and people can actually tolerate it long term.
If they can prove that.
Yeah.
If they could show durable efficacy with a clean safety profile, that's not just best in class. That is potentially transformational for how the illness is treated.
And that explains the huge upside people are talking about.
Exactly.
Okay, so the science sounds incredibly compelling. But science, especially late-stage clinical trials, cost a ton of money. So how are they funding this?
Well, this is where we saw some really positive momentum in their recent Q3 2025 earnings report.
What stood out to you there?
The financial discipline. They reported an EPS of -6 cents. Now, on its face, that's a loss. But the consensus on the street was for -10 cents.
So that's a 40% positive surprise, a 40% beat on the loss.
It's a whopping beat. And that doesn't just happen by accident. It signals that management is keeping a very, very tight lid on costs.
Right, which you want to see from a company at this stage.
That control meant a better balance sheet in Q3. Their net loss was down to $4 million, and shareholder equity improved to $4.5 million.
But that's just the Q3 numbers. The real financial story here has been their capital raising, hasn't it?
Oh, absolutely. They have been incredibly busy strengthening their cash position.
Busy is an understatement. So break down how they pulled all that cash in.
Sure. So it started with a $9 million public offering back in September. They netted about $8.1 million from that.
Okay, pretty standard.
But then, and this is the really fascinating part, they generated another $6.4 million in October and November just from people exercising their warrants.
Wait, $6.4 million just from warrant exercises? That's actually pretty significant.
Very significant.
For anyone listening, that's fresh cash coming into the company without them having to do a whole new dilutive offering. It's a sign of confidence from those warrant holders.
Precisely. And then, on top of all that, they layered in another $1.2 million using an at-the-market offering.
Okay, let's stop on that jargon for a second. What exactly is an ATM?
Right. Think of it like this. Instead of a big, splashy offering that can crush the stock price.
Like opening a fire hose.
Exactly.
Sure.
An ATM lets them sort of trickle shares into the market over time, selling them when the price is favorable. It's much less disruptive.
It's like a controlled leak. Okay, so you add up the offering, the warrants, the ATM.
Yeah.
That's a pretty substantial war chest they've built in just a few months.
Correct. And the key takeaway here really is that their liquidity is now adequate. They've bought themselves a runway to fund those crucial late-stage programs for brilaroxazine.
So now that they have the cash, let's go back to the drug itself. They just put out new data, right?
They did, from the open-label extension trial. And it showed durable long-term efficacy.
How long-term are we talking?
The trial had over 400 participants, and they followed 156 of them for over a year.
And showing that the drug still works well after a full year, that is huge for a CNS treatment. It speaks directly to that tolerability and safety profile we were talking about?
Absolutely. If patients are staying on it that long, it's working, and it's not causing unbearable side effects. And all of this is protected by a pretty strong moat.
The intellectual property.
A very strong IP portfolio around brilaroxazine. It's a legal fence that supports their future pricing power and keeps generics at bay.
It makes sure that if they get this thing to market, they can actually make money from it.
So you have what looks like world-class science, and you have fresh financing. Should be a pretty straightforward success story,
Oh,
Rick.
I'm sensing a but coming.
But this is where it gets really interesting and, frankly, pretty complex.
Hmm.
The company is grappling with some fundamental corporate structure issues.
Ah, the classic small cap biotech dilemma. They're fighting a war on two fronts, the science and the stock market.
Exactly. The Nasdaq listing compliance,
Mhm.
they actually scored a temporary win in October.
Right, I saw that. They got back over the minimum market value requirement.
They did. They held above that $35 million mark. So that averted one immediate delisting threat.
Well, there's another much bigger issue looming, isn't there? The stock price itself. It's been stuck under $1.
Precisely. And that brings us to the most critical date on the calendar, their virtual annual meeting on December 18th.
Okay, and this isn't just a routine meeting?
Not at all. There are two proposals on the agenda that will basically decide the company's future on the Nasdaq.
So what are shareholders voting on that's so important?
Two things. First, they want to expand the number of authorized common stock. That gives them more shares to work with for future fundraising.
And the second one?
The second, and this is the pivotal one, is granting the board the flexibility to do a reverse stock split.
Okay, let's really explain the reverse split. It sounds scary to a lot of investors, but it can be a necessary tool.
It is. The board needs it as an emergency brake. Nasdaq requires a minimum bid price of $1. If you trade below that for too long, you're out. A reverse split is how you fix that and stay listed.
And it doesn't change the actual value of the company, right? It's like exchanging 10 $1 bills for a single $10 bill.
Perfect analogy. The total value is the same, but the number of shares goes down, which pushes the price per share up. It gets them back into compliance.
So these votes are absolutely pivotal, not just for the listing, but for market perception.
For sure. Because getting delisted to an over-the-counter market is a death knell for institutional investment.
That's a key point. Why do the big funds care so much about that dollar price and the exchange it's on?
It's all about their own rules, their mandates. Many big funds are simply not allowed to own stocks that trade below, say, $1 or $3, or stocks that are on the OTC markets.
So clearing this hurdle literally unlocks a whole new universe of potential buyers.
It unlocks the institutional capital they need to really get the valuation they deserve based on the science.
So December 18th is circled on the calendar, assuming they get through that. What are the next catalysts we should watch for in early 2026?
The next big one is the Q4 earnings report. That'll probably be in early February.
And what are you looking for there?
Two things. One, do they continue that strong EPS improvement? And two, an update on the cash runway. How much time did that $15+ million they just raised actually buy them?
And what about market events? Things outside of their control. With over 100 million shares out there, technicals have to matter.
They matter a lot. So first, you've got the ETF and index rebalancing around December 23rd. That can create forced buying or selling. Then January 15th is the deadline for institutional 13F filings.
Ah, the 13Fs. Let's zoom in on that. Why is that date so important for a company like this?
Because the 13Fs show us what the smart money was doing in the last quarter. If we see big respected funds taking new positions in Reviva, it's a huge validation signal to the rest of the market.
It's a major catalyst. Okay, speaking of catalysts, let's get into the speculative stuff, the rumors that could change the whole story overnight.
The biggest one, the highest upside rumor, is about a partnership for brilaroxazine.
That makes sense. A big pharma company stepping in.
Exactly. The clinical data is strong enough now that the market is buzzing about a potential strategic development or commercialization deal.
And a partner would bring the money and the global infrastructure to actually launch the drug, which Reviva can't do on its own.
A deal like that would likely mean a huge upfront cash payment. It would completely de-risk the company from a financing perspective.
And the other rumors?
There's chatter that if that reverse split gets approved in December, the board will execute it very, very quickly to get the compliance issue off the table.
Makes them a cleaner target for a potential partner, right?
It does. And finally, there's speculation they might monetize non-core assets. Sell or license out some of their other pipeline programs to raise cash and focus everything on brilaroxazine.
Okay, so massive potential, new financing, big hurdles ahead. Let's play devil's advocate for a second. The entire value here rests on one single drug. Isn't that single asset dependency the biggest risk of all?
You're absolutely right to point that out. It is the defining risk. If anything goes wrong with brilaroxazine, a regulatory delay, a trial setback, the impact on the stock would be catastrophic. There's no plan B.
And even with the new cash, delays are common. They'll need more money eventually. The clock is always ticking.
It's a perpetual risk. But that high-risk, high-reward profile is reflected in the analyst targets. They range from $2 all the way up to $11.
Wow, that's a huge spread.
It is, and it's the market saying either this drug fails and it's worth a couple of bucks, or it's truly transformational and it's worth much, much more.
So to synthesize this whole outlook, what's the bottom line for the next few months?
Reviva's near-term path hinges almost entirely on that shareholder vote on December 18th. They have to get those proposals passed. The science provides the massive upside, but these corporate actions are the immediate hurdles they just have to clear.
They have to stabilize the corporate structure before the market can fully price in the science.
That's it in a nutshell.
Which leaves us with a final provocative thought for you to consider. If those proposals do pass next month, the company gets this powerful financial flexibility, but it raises the question of how quickly the board might use that new authority to restructure the share count with a reverse split. That action is necessary for compliance, but it always shocks the market. It's a real double-edged sword.
And the timing of that decision will define the stock's performance heading into 2026.
Make sure you subscribe so you don't miss our next analysis.